Hello, everybody, and welcome to our Module 3 section covering the topic of current assets. So, first of all, let's talk about the term current versus long-term. Current is also known as short-term, and you could call it non-current or long-term. It's the same basic thing. Generally speaking, the defining point between current and long-term is when the asset is expected to be used or converted to cash within 1 year of the balance sheet date. Now, that's a general rule that applies to almost every company, but there is an exception for certain companies or industries where their operating cycle takes longer than a year to complete. Now, what that basically means is the operating cycle is essentially the average amount of time it takes to sell their inventory and collect their cash. So if you have companies that have long-term inventory type cycles where they hold inventory for more than a year on average, then whatever that average time is, might be 18 months, possibly 2 years, that would become the breaking point between current and long-term. Now, generally, we're talking construction firms. Those types of things might be longer than a year, but normally most manufacturers and certainly merchandisers on average hold inventory for less than a year. So that's just the general rule we'll go with is 1 year. Now, the current assets we're going to discuss in this particular module, which covers the majority of them, the main ones, we have the cash and bank reconciliation. So cash is the asset, the bank reconciliation is the control related to it. Then we have supplies. We'll see how to handle those. And we spend some time on accounts receivables and then bad debts that relate to accounts receivables. We'll just very briefly discuss notes receivables and how they differ from accounts receivables. And then we'll deal with inventory, a pretty big topic there. So cash, let's start with that one. When we talk about cash, we're talking about, of course, the money on hand. That's what when you think of cash, you tend to think of the money on hand. The bills and coins that might be in the cash registers. You might have a safe. Now, obviously, most companies don't hold a lot of cash on hand. This also does include checks and credit card receipts that the company may have in their cash register. This is considered cash. Now, petty cash is a subset of the cash account. It's certainly cash that's on hand, but generally it's a relatively small amount. It's used for quick purchases that might be needed for business purposes. Now, you'll also have certain bank accounts that can be included. Generally, if you have an operating checking account that you actually run the business with, this would be included in cash. Certain savings or investments would not be. Now, I say that most investments would not be, but we do have something known as a cash equivalent, which is a very short term. So we're not talking just a year anymore. We're talking generally 90 days where this investment, this low risk investment, if it's going to be cashed out within 90 days, we would call that a cash equivalent, and it gets lumped together with cash. In fact, they generally refer to it as cash and cash equivalents. Now, there are some controls related to cash that are important, and the reason they're so important is that cash tends to be one of the most commonly stolen assets just by its nature. And the nature is that it's relatively hard to track. If somebody steals the cash, you're not going to be able to track that particular cash down generally. And it's very easy for the fraudster to use once they've stolen it. So yes, cash has serial numbers, but nobody really goes and tracks those serial numbers, keeps track of them on a regular basis, unless it's, of course, for a specific investigation, things like that. So cash is the most commonly stolen, and because of this, we really want to have strong internal controls in place for it. Some common examples would just be safes. If you do happen to have a lot of cash on hand, have safes. Now again, as far as you have banks, you have casinos, they might have a lot of cash on hand, but that's about it for the most part. Safes, cameras to record what's going on, guards, of course, and bank reconciliation is the control we're going to talk about today. So the bank reconciliation, the thing about this, the reason it's so important is that neither the bank or the company always know about exactly the same information. They don't always know everything about the cash transactions at that same time. And again, it is all about timing, basically. What does the bank know at that time? What does the company know at a certain point in time? And it's going to be different. So the reason it's different is you have certain things like a deposit that was made after the cutoff date for the bank. It's a valid deposit. Just because the bank didn't know about it when they cut it off and did the bank statement doesn't mean it's not a valid deposit. So the company knows about it before the bank does. It might even be mailed overnight. It's still a valid deposit. An outstanding check that is not yet cleared, again, the company knows about it, but the bank apparently does not. And that's a check that you've written to somebody and they just haven't cashed it yet. You might have a service charge that the bank knows about before you know about it. They've already deducted it from your bank statement. You're just now finding out about it. And there might be a deposit that was made directly to your bank on your behalf by a customer or someone that owed you money. This is sometimes referred to as a lockbox arrangement. This definitely happens, and the bank knows about it before you do. There might be a non-sufficient funds check or an NSF check. And what this basically means is that a customer has written you a check that bounced. Now, you thought it was good cash, so you have it in your cash records, but the bank said, no, it's not valid. We're not including it on your bank statement. So you need to make an adjustment to correct it. Interest income, really kind of the opposite of a service charge. It's the bank knows about it first. It's an increase to your cash. You're just now finding out about it. And of course, you might have either bank or book errors that exist, and just depends on what it is, who knows about it first. If it's an error, the other party doesn't need to even know about it. It'll be corrected, or it needs to be corrected. So let's take a look at a pretty simple example here. This is what a general bank reconciliation would look like. You have the bank side, the bank's cash balance, which comes from the statement, and the company's book balance, which comes from their cash account. Now, if you notice, they're quite a bit off, and that's not a bad thing necessarily. There might be a lot of reasons for it. We'll fix it. Here, a deposit in the amount of $52,000 was deposited into the night depository of the bank on July 31st, but it did not get recorded in the July 31st bank statement balance. So it's already included in our balance. We already knew we made the deposit. We don't have to make any corrections on our side, but on the bank side, we have to add in the $52,000 in this reconciliation. Here we have two separate checks, a $575 check and a $1,500 check, totaling $2,075. These were outstanding as of the bank statement date. And again, we already knew about those withdrawals. We've already included it in our book balance. The bank doesn't know about it, so we have to subtract it out. An NSF check in the amount of $500 was written by a customer, and it was returned by the bank to us. So it's already been taken out of the cash balance, or it was never put in there to begin with, I should say. So the bank's cash balance is correct for this issue, but our books are not. We need to pull this $500 back out because it's not a valid actual cash payment. So we subtract it out, and we'll get with the customer and tell them they need to pay us the money. A bank service charge in the amount of $50 was included in the July 31st bank statement. The bank already knows about it. They've already included in their amount. We need to subtract this service charge out on our side. Notice we're getting closer to reconciling. Interest in the amount of $125 was deposited into our account by the bank. So again, the bank already knew about it. They've already recorded it. We now need to add this in. The bank collected $1,000 from a customer on our behalf as part of the lockbox service that we established with the bank. The bank already knows about it. It's already included. We need to add this money in on our side. The bank erroneously posted another company's check, in other words, a withdrawal, in the amount of $5,000 to our account. There's nothing we need to do on our side. It's not a valid cash amount. the bank recorded that withdrawal. They subtracted money in their cash balance. We need to reverse it by adding that amount back in. They made another mistake. They posted another company's deposit into our account in the amount of $3,000. The exact opposite. They have that positive $3,000 in the original cash balance, but it needs to be reversed by subtracting it out. After reconciling the bank statement, we noticed that a check that was written to pay for the current month's utilities in the amount of $250 was improperly recorded in our own books as $520. So when you see this issue, first of all, it's a book side issue. It's our company's cash account that's wrong. But you need to pay close attention to the amounts. It was improperly recorded as $520. So the proper amount is $250. We should have only subtracted $250 out, but instead we subtracted $520 out. So we subtracted $270 too much, and we need to reverse it by adding that amount back in. $270 added back in. Now we'll get reconciled. $67,800 on both sides. We should be good to go. Now, as far as the adjustments go, we only need to adjust items on our book side. Generally, the bank, it's just a very short-term type thing. They'll fix it. But if you happen to see an error that's continued for more than a month, you might get with them, especially if it's a large amount. You might get with them ahead of time and say, hey, there's an error. Can you correct my account? But there's nothing you need to do in your own journal entries for this. We can't obviously hack into the bank's journal entries either. So we just need to notify them at most. Now, the company side, though, if we have any reconciling items there, we absolutely have to adjust for those. Nobody else is going to. It's never going to get fixed if we don't adjust it. So we have to take a look at all of these items. We have, 5 items here on our records, and we need to adjust for these. So an NSF check in the amount of $500 was returned by the company or by the bank to the company. So what that means is, of course, we have to credit cash for $500 to take the money out of our account. It's not valid. There has to be a debit for $500, and this would go back into the accounts receivable for this customer. They still owe us the money. They need to pay us. We need to notify them. A bank service charge in the amount of $50 was included in the statement. So again, we're subtracting cash out. We do that with a credit. The debit for $50 would go to something like a bank service charge, miscellaneous expense, whatever account they use for that. Interest in the amount of $125 was deposited into our account. So this is going to be a debit to cash to increase it, and a credit to interest revenue or miscellaneous revenue, again, whatever account name they use. The bank collected $1,000 from a customer, and we assume this is an accounts receivable. It could possibly be a notes receivable. We'd probably want to know more information about it, but we debit cash to increase it for $1,000. And again, we're either crediting accounts receivable if it's just something they owed us for a sale, or if they borrowed money from us and now they're paying it back, it might be a notes receivable. And we'll talk more about that difference later on in this module. So that takes us through the bank reconciliation. We make the adjustments, our cash record is updated, and we go on until the end of the next month. Now we're going to talk about supplies, another important current asset the company might have. The thing about supplies is they differ from inventory because we're not selling supplies. We're using them in our production or service. They tend to be considered short-term because, why would you want to buy more than a year's worth of supplies? It's just wasting excess money. So generally supplies are considered current assets. And the supply itself, when you hear that account, or office supplies, manufacturing supplies, whatever you call it, that's an asset because these are amounts that are in stock. We have not yet used them. Once you do use them, it gets moved over to supplies expense. You decrease supplies and increase supplies expense. That's the amount of supplies used up that particular period. So here would be the journal entry for that. If we use 10,000 of supplies this period, we debit supplies expense, credit supplies, we'd be good to go. Now, as far as the calculation of supplies, we generally, at the end of the period, we have to start by looking at the beginning balance of supplies that we had from last period's ending amount. We add in any new supplies we purchased this year, and that gives us basically the supplies we could use this year. But we subtract out the ending balance of supplies because obviously we did not use those, and that gives us the supplies we must have used this period. So that takes us to a good pausing point for part 1 of this module. We'll come back in another video and talk about part 2, which we continue on with our other current assets that take a little bit longer to go through. So I will talk to you in the next video with the other parts of the current assets. Thank you.